Imagine you have a crystal ball. It is the year 1920. You can see the future of the stock market perfectly. You know exactly when the Great Depression will hit. You know when World War II will crash the market. You know about the dot-com bubble and the 2008 financial crisis. Now, imagine you play a game against a simple algorithm. You, the God mode investor, are allowed to time the market perfectly. You only buy at the absolute bottom of every crash. The algorithm, the dummy, knows nothing. It just buys $100 worth of stocks every single month, regardless of the price. It buys at the peak, it buys at the crash. It just keeps buying. Who wins over 40 years? According to the data analyzed by Nick Maggiulli, the dummy wins. Why? Because while you were sitting in cash waiting for the perfect bottom, the dummy was compounding dividends and capturing the general upward trend of human productivity. You tried to be smart, and it cost you a fortune. Welcome to the definitive masterclass on Just Keep Buying. Most financial advice is based on fear, hype, or complex charts that don't work. Nick Maggiulli is a data scientist. He ran the numbers on over 100 years of market history to answer one question. What is the mathematical path to wealth? The answer is boring. It is simple, and it works 100% of the time if you have the timeline. In this 5-part series, we are going to kill your financial anxiety. We are going to prove why you should never wait for a dip, why you should stop worrying about your coffee habit, and how to turn your money into a machine that runs forever. This is Part 1, the saving trap. Part 1, the saving trap. We have all heard the advice. It is the favorite line of every financial guru on TV. If you just stop buying that $5 latte every morning and invest that money instead, you will be a millionaire. Nick Maggiulli calls this the latte fallacy. Mathematically, it is true. If you save $5 a day and get 7% returns, eventually you have money. But practically, it is nonsense. Why? Because it distracts you from the variable that actually matters. Let's look at the math of saving versus investing. Imagine you have $1,000 to your name. You are 22 years old. You spend 10 hours researching the best stock to pick. You find a winner. You get a massive 100% return in 1 year. Congratulations! You made $1,000. That's great, but it won't change your life. You can't retire on $2,000. Now imagine you spent those 10 hours learning a new skill, Excel, coding, or sales. You use that skill to negotiate a $5,000 raise at your job. You just made 5x more money by focusing on your income than you did by being the greatest investor in the world. The rule? Focus on saving when you are poor. Focus on investing when you are rich. The save-invest continuum. Most people obsess over investment returns when they should be obsessing over their savings rate. Maggiulli introduces a concept called the save-invest continuum. Phase 1, the saver. You have less than $100,000 in assets. Your investment returns, even if they are great, will be smaller than the amount of money you can save from your paycheck. Strategy? Stop looking at stock charts. Look at your career. Your biggest asset is you. Human capital. You need to increase the size of your shovel. Phase 2, the inflection point. You have roughly $100,000 to $500,000 invested. This is where the magic happens. In a good year, your investment returns might actually match your annual contribution. The money is starting to work as hard as you do. Phase 3, the investor. You have substantial assets. A 10% swing in the market makes or loses you more money than you earn in your entire salary. Strategy? Now asset allocation matters. Now fees matter. Now you need to protect the pile. The mistake? Most young people act like Phase 3 investors when they are in Phase 1. They stress about optimizing their portfolio when they have $500 in the account. If you have $500, it doesn't matter if you're in Bitcoin or bonds, it matters that you find a way to make it $1,000. Why you should stop budgeting and start earning. This brings us to a controversial point. Maggiulli argues that stressing over small expenses is a waste of mental energy. You cannot save your way to rich. There is a limit to how much you can cut your expenses. You can only cut to zero and you'll starve. There's no limit to how much you can increase your income. If you are spending 3 hours a week clipping coupons to save $20, you are valuing your time at $6.60 an hour. If you are capable of earning $50 an hour, you are literally losing money by trying to save it. The data? The data shows that the biggest driver of wealth for people under 40 is not frugality, it is earnings growth. The people who retire wealthy aren't the ones who skipped the latte, they're the ones who bought the latte, caffeinated themselves, and worked effectively to get promoted. Human capital versus financial capital. Let's reframe how you see yourself. You have 2 bank accounts: financial capital, the money in the bank; human capital, the value of all your future earnings. When you are young, your financial capital is low, but your human capital is massive. You have 40 years of earnings ahead of you. It's like a bond that pays you a salary every 2 weeks. When you are old, your human capital drops to zero, you stop working, but your financial capital should be high. The goal of investing is simply to convert your human capital into financial capital before you run out of energy. You are selling your labor today to buy freedom tomorrow. If you understand this, the market crashes don't scare you. If the market crashes 50% tomorrow, your financial capital takes a hit, but your human capital, your ability to earn, is likely unaffected. In fact, a crash is good for you. It means your human capital can buy financial capital at a discount. The 2x rule: how to spend without guilt. So, does this mean we should blow all our money? No. Maggiulli gives us a simple heuristic to handle spending without a budget. He calls it the 2x rule. Whenever you want to splurge on a want, a nice dinner, a new phone, a handbag, you must invest an equivalent amount. You want those $200 shoes? Fine. You must buy the shoes for $200 and invest $200 into your brokerage account. The shoes actually cost you $400. Why this works? It removes the guilt. You proved you can afford it. You didn't steal from your future, you funded it. It acts as a natural brake. If you can't afford to buy it twice, you can't afford it. This turns spending into a wealth-building trigger. Every time you treat yourself, you treat your future self too. Homework: calculate your burn rate. Here is your assignment for part 1. I want you to figure out where you are on the save-invest continuum. Look at your annual income. Look at your investment returns from last year, or assume an average of 7% of your total invested assets. The question: is your expected investment return higher than what you can save in a year? If no, you are a saver. Stop worrying about stock picks. Focus on increasing your income. Ask for a raise. Start a side hustle. If yes, you are an investor. Now you need to worry about asset allocation and fees. Stop playing the wrong game. In the next part, we are going to look at the most common question in investing: is now a good time to buy? We are going to use 100 years of data to prove why waiting for the dip is the most expensive mistake you can make. We are covering part 2, the timing myth. I'll see you there. Part 2, the timing myth. Even God can't win. It is the most common question in finance. You get a bonus or you sell a house. You have $50,000 sitting in your bank account. You look at the stock market. It is at an all-time high. The news is talking about inflation. The pundits are predicting a crash. Your intuition screams, don't buy now. Wait for the crash. Wait for the dip. Get a bargain. It feels smart. It feels prudent. But Nick Maggiulli has a warning for you. Waiting for the dip is not just difficult, it is a losing strategy. In fact, Maggiulli ran a simulation that proved that even if you were God, even if you knew exactly when the bottom of every crash would happen, you would still likely lose to a dummy who just bought immediately. Welcome back to the Just Keep Buying Masterclass. In part 1, we learned why you should focus on income, not just saving. Today, we are going to destroy your fear of buying at the top. we're going to look at the math of market timing, explain the concept of cash drag, and prove why the best time to invest was yesterday. This is part 2, the timing myth. The God versus the dummy experiment. Let's run the simulation. We're going to compare two investors over a 40-year period, 1920 to 1960 or 1970 to 2010. The data holds up in almost every era. Investor A, buy the dip, God mode. He saves $100 a month. He puts it in a savings account. He never buys stocks until the market has crashed and sits at the absolute bottom. Because he is God, he times the bottom perfectly every single time. He dumps all his saved cash into the market at the lowest possible price. Investor B, DCA, the dummy. He saves $100 a month. He buys $100 worth of stocks immediately. He doesn't look at the price. He buys at the peak. He buys at the crash. He buys in the middle. The result? Who has more money after 40 years? In the vast majority of historical periods, the dummy, Investor B, wins. How is this possible? How can buying at the bottom lose to buying at the top? The answer is compounding. While buy the dip was sitting in cash for 5 or 6 years waiting for a crash, the market was going up. He missed out on years of dividends and growth. When the crash finally came, the bottom was often still higher than the price was 5 years ago. He waited years to buy at a bargain price of $50, ignoring the fact that he could have bought it for $30 5 years earlier. The lesson: time in the market beats timing the market. The penalty for sitting in cash is almost always higher than the benefit of buying cheap. The cost of waiting, cash drag. This phenomenon is called cash drag. Cash is an anchor. In an inflationary world, cash loses value every single day. Stocks, productive assets, tend to gain value. If you hold a large percentage of your portfolio in cash waiting for an opportunity, your portfolio is being dragged down. Maggiulli's data shows that buying the dip underperforms just keep buying more than 70% of the time. Think about that odds ratio. If you try to time the market, you have a 70% chance of ending up poorer than if you had just closed your eyes and pressed buy. And that assumes you time the bottom perfectly, which you won't. If you miss the bottom by just a few weeks, your odds get even worse. So you're playing a game where you have to be perfect just to have a slight chance of winning. And if you're imperfect, you're guaranteed to lose. Why play that game? The all-time high fallacy. Okay, you say, I won't try to time the dip, but surely I shouldn't buy right now. The market is at an all-time high. It has to come down. This is another optical illusion. We look at a stock chart like a mountain. We think if we're at the peak, the only way is down. But the stock market is not a mountain. It's a staircase. Maggiulli analyzed the data on all-time highs. Question: if you buy at an ATH, what are the odds that the market will be higher 1 year later? Answer: roughly 70%. Question: if you buy on a random day, not an ATH, what are the odds? Roughly 70%. There is statistically no difference in future returns whether you buy at a record high or a random Tuesday. Why? Because all-time highs are usually followed by new all-time highs. The S&P 500 spends a massive amount of its life sitting at or near an ATH. That's what growing assets do. If you refused to buy at an ATH, you would have missed almost the entire bull run of the 2010s. The rule: the market is usually going up. Therefore, the price today is likely lower than the price next year. Therefore, buy today. The only exception: luck versus skill. Is there ever a time to hold cash? Yes, but not for timing the market. You hold cash for peace of mind, an emergency fund, or for a specific purchase, a house down payment in less than 2 years. But you do not hold cash as a strategic reserve to outsmart Wall Street. Maggiulli admits that yes, occasionally someone gets lucky. If you happened to hold cash in 2007 and bought in March 2009, you look like a genius. But for every person who did that, there are 10 people who went to cash in 2012 thinking it was too high and sat on the sidelines for a decade while the market tripled. Don't confuse luck with strategy. A strategy that relies on predicting the future is not a strategy, it's gambling. A strategy that relies on the mathematical certainty of compounding is investing. Just keep buying. This brings us to the title of the book. The phrase, just keep buying, is not just a slogan, it's a survival mechanism. It removes the psychological burden. If you're trying to time the market, you're constantly stressed. Is this the top? Is this the bottom? What did the Fed say today? You become a slave to the news cycle. If you adopt the just keep buying philosophy, you're free. Market crashes 20%, just keep buying. You get more shares for your money. Market rips up 20%, just keep buying. Your assets are growing. Inflation is high, just keep buying. Assets protect against inflation. You treat investing like a bill. You pay your mortgage, you pay your electricity, you buy your stocks. It's boring, and it will make you rich. Homework: the cash audit. I want you to perform a cash audit. Look at all your bank accounts, total up your cash, subtract your emergency fund, 3 to 6 months of expenses, subtract any cash needed for a major purchase in the next 12 to 24 months, wedding, house. The question, is there anything left over? If you have $10,000 waiting on the sidelines, you are suffering from cash drag. You're trying to beat the dummy. Stop it. Make a plan to get that money into the market. But should you put it all in at once or slowly over time? That's the great debate, lump sum versus dollar cost averaging. And the answer might surprise you. We'll cover that in Part 3, the core strategy. I'll see you there.
Part 3, the core strategy. Lump sum versus DCA. Imagine you just inherited $100,000, or maybe you sold a business, or maybe you just did the cash audit from Part 2 and realized you have way too much money sitting in a savings account. You know you need to invest it. You know cash is trash, but you are terrified. You look at the market and it looks shaky. You think, what if I put all $100,000 in today and the market crashes 20% tomorrow? I'll lose $20,000 instantly. I'll feel like an idiot. So you come up with a plan. I'll play it safe. I will invest $10,000 a month for the next 10 months. That way, if the market crashes, I can buy cheaper. I'll average out my cost. This is called dollar cost averaging, DCA. It feels smart, it feels responsible, it feels safe. But Nick Maggiulli ran the numbers on this too, and the data is ruthless. By slowly dripping your money into the market, you are statistically likely to lose money. Welcome back to the Just Keep Buying Masterclass. In Part 2, we learned why you should never wait for the dip. Today, we are going to learn how to deploy your capital. We are going to settle the lump sum versus DCA debate once and for all, and find out why your brain's desire for safety is actually costing you a fortune. This is Part 3, the core strategy. Defining the terms, paycheck versus windfall. First, we need to make a critical distinction. There are two ways people use the term dollar cost averaging, and it confuses everyone. Definition 1, investing from cash flow, the paycheck. You get paid every 2 weeks. You take $500 from your check and buy stocks. You are technically averaging your price over your lifetime. This is good. This is just keep buying. You have no choice here because you don't have the money up front. You invest it as you earn it. Definition 2, investing a windfall, the pile. You already have a large pile of cash sitting there, say $50,000. You have the choice to put it all in today, lump sum, or spread it out over 12 months, DCA. This is the debate we are having. The question is, when you have the cash right now, should you wait? The data. Lump sum wins, almost always.
Maggiulli analyzed historical data across stock markets, US, UK, Australia, Germany, going back nearly a century. He compared lump sum, investing the entire pile on day one, DCA, spreading the pile out over 12 months, buying 1/12 each month. The result? Lump sum outperforms DCA approximately 75% of the time. Why? Because going back to the core truth of the stock market, markets go up more often than they go down. The stock market is a positive expectancy game. On average, it drifts upward. Every day you leave your money in cash, you are betting against that upward drift. When you choose to DCA over 12 months, you are essentially holding a large portion of your portfolio in cash for a year. Since the market usually goes up during that year, you usually end up buying the shares later at a higher price than you could have bought them on day one. You are paying a premium for safety. If the market goes up 10% this year and you drip feed your money, you miss out on half of that growth. Lump sum wins because it maximizes your time in the market. The regret insurance premium. So if the math is so clear, why does everyone love DCA? Why do financial advisors recommend it? Because we are not computers. We are emotional animals. DCA is not a wealth maximization strategy. DCA is regret minimization. It is regret insurance. Think about the worst case scenario. You put $100,000 in today. The market crashes 30% next week. If you did lump sum, you are devastated. You can't sleep. You might panic sell at the bottom, locking in your loss. If you did DCA, you are actually happy. You think, great, the market crashed and I still have 90% of my cash waiting to be deployed. I get to buy the dip. DCA protects you from the psychological risk of bad timing, even though it exposes you to the mathematical risk of lower returns. You are paying a fee, lower expected returns, to buy peace of mind. Maggiulli's advice? If you can handle the volatility, if you have nerves of steel, lump sum is the correct move. But if you know that a sudden crash would make you panic sell, then use DCA. It's better to have a suboptimal strategy that you can stick to than an optimal strategy that makes you quit. When DCA makes sense, the exceptions. Are there times when DCA actually wins mathematically? Yes, DCA wins in a falling market. If the market drops for the next 12 months, DCA is superior because you are buying at lower and lower prices. Lump sum effectively buys at the peak before the drop. But here's the problem. You don't know if the market is going to fall, and statistically, falling markets are rare. Bull markets, or uptrends, last years. Bear markets, or downtrends, last months. Betting on a bear market is betting on the underdog. But there's a specific type of asset where DCA is mandatory: high volatility, speculative assets. If you're buying Bitcoin or a single risky tech stock, the volatility is so extreme that lump sum is dangerous. A 50% drop in crypto is normal. In these cases, DCA helps smooth out the extreme variance. But for a diversified index fund like the S&P 500, lump sum is king. The buy the dip fantasy. Revisited. Let's look at one final twist. Some people say, I will hold cash and only buy when the market drops 10%. This is a form of timing the market we discussed in part 2. Maggiulli calls it buying the dip with thresholds. He ran the numbers. Strategy A, just keep buying. Invest monthly regardless of price. Strategy B, save cash and only buy when the market is 10% below its all-time high. Result, strategy A wins significantly. Why? Because sometimes the market doesn't drop 10% for years. While you're waiting for that 10% correction, the market doubles. Then, when the 10% drop finally happens, the price is still 50% higher than when you started waiting. You end up buying the dip at a price that is higher than the peak you were afraid of years ago. The quote, more money has been lost waiting for corrections than has been lost in corrections themselves. Peter Lynch. Homework. The deployment plan.
Here is your assignment for Part 3. It is time to deal with the cash pile from your audit in Part 2. Step 1. The gut check. Ask yourself, if I invest this money today and the market drops 20% next month, will I sell? If yes, you need regret insurance. Set up a DCA plan. If no, you are rational. Do lump sum. Step 2. Execute. If DCA, do not drag it out. The data shows that DCA works best over a short window, 6 to 12 months. Do not spread it over 3 years. That is too much cash drag. Divide your pile by 12 and set up an automatic transfer for the first of the month. If lump sum, take a deep breath, log in, click Buy, and then do not look at your account for 3 months. You have now mastered the entry, but once you're in the market, things get scary. The volatility starts, the news gets bad. How do you handle the emotional roller coaster of a crash without selling? We're going to learn why you should actually pray for the market to crash in Part 4, the fear of volatility. I'll see you there.
Part 4. The fear of volatility. Why you want a crash. Imagine you walk into your favorite supermarket. You go there every single week to buy steaks for your family. You are a net buyer of steaks. You walk to the meat counter and you see a sign. Due to a supply chain issue, the price of steak has doubled. Are you happy? No, you are furious. It now costs you twice as much to buy the same dinner. Now imagine the opposite. You walk in and there is a panic. No one wants steak today. The price has dropped by 50%. Are you scared? Do you run out of the store screaming, "The steak market is crashing, get me out of here"? No, you fill your cart. You buy as much as you can fit in your freezer. Now apply this logic to the stock market. If you are reading this, you are likely under the age of 60. You are still working, you are saving money every month, you are a net buyer of stocks. So why do you celebrate when the market goes up, and why do you panic when the market goes down? You are celebrating steak becoming more expensive. It makes no sense. Welcome back to the Just Keep Buying Masterclass. In Part 3, we deployed your cash. Now we have to live with the consequences. Today, we are going to rewire your brain to stop fearing market crashes and start seeing them for what they really are, the only reason you will ever get rich. This is Part 4, the fear of volatility. Net buyers versus net sellers. The single most important question you must ask yourself is, am I a net buyer or a net seller? Net seller. You are retired, you are living off your portfolio, you are selling stocks every month to pay for groceries. Market crash equals bad. You have to sell more shares to get the same cash, depleting your portfolio. Net buyer. You are working, you are saving, you are putting money into the market. Market crash equals good. Your monthly contribution buys more shares. Warren Buffett famously said, if you are going to be a net buyer of stocks for the next 10 years, you should hope for lower prices. When the market rips upward to all-time highs, you should actually feel a little sad. Sure, the number on your screen looks bigger, which strokes your ego, but your future money is buying less value. You are paying full retail price. When the market crashes 20%, the number on your screen looks smaller, but your future money is buying a dynasty. You are getting the clearance sale price. The math of recovery, the Great Depression test. But you argue, what if the market never recovers? What if I buy before a massive crash like 1929? Nick Maggiulli stress-tested the Just Keep Buying strategy against the worst financial disasters in history. Let's look at the absolute worst-case scenario, the Great Depression, 1929. Imagine you started investing immediately before the crash. The market drops 89%. The economy is in ruins. If you put in a lump sum and walked away, it took 25 years to get your money back. That is terrifying. But what if you followed the strategy? What if you just kept buying? What if you continued to put a small amount of money in every month throughout the depression? Because you were buying shares at rock bottom prices, down 80 to 90%, you lowered your average cost massively. Your recovery time dropped from 25 years to roughly 7 years. Even in the worst economic collapse in modern history, the consistent buyer was back in profit under a decade. In more mild crashes, like 2008 or 2020, the recovery time for a consistent buyer is often just months or a couple of years. As long as you do not stop, the crash accelerates your eventual wealth. Volatility is the price of admission. Why do stocks return 8 to 10% a year while cash returns 1 to 2%? Is it because stocks are better? No, it's because stocks are scary. In finance, there is no such thing as a free lunch. Return is the compensation you receive for taking risk. The risk in the stock market is volatility. It's the stomach-churning feeling of watching your life savings drop by $10,000 in a single day. That pain is the fee. If stocks never went down, everyone would buy them. They would be as safe as a savings account, and therefore they would pay the same low interest rate as a savings account. Reframing the crash. You are not losing money when the market drops. You are paying the fee to earn the 10% long-term return. If you panic and sell, you have paid the fee, but you didn't stay for the show. That's the only way to lose. The quote, "Volatility is not a fine to be paid. It is an entrance fee for the market's returns." Morgan Housel, referenced by Maggiulli. The sequence of returns risk. There is one group of people who should fear a crash. If you are about to retire in 1 or 2 years, you face sequence of returns risk. This is the risk that a crash happens right at the moment you switch from buyer to seller. If the market drops 50% the day you retire, your retirement plan is ruined. This is why asset allocation changes as you age. Young, 20 to 40, 100% stocks. You want volatility, you want growth, you have decades to recover. Old, 60 plus, 60% stocks, 40% bonds or cash. You introduce bonds to dampen the volatility. You sacrifice some growth to ensure you don't run out of money. But if you are 30 years old and holding bonds for safety, you are misunderstanding the math. You are protecting yourself from a risk, volatility, that doesn't actually hurt you yet. You are paying for insurance on a house that won't be built for another 30 years. The even-if mental exercise. When the next crash comes, and it will come, you need a mental shield. Use the even-if technique. Look at your portfolio. Say to yourself, even if the market drops 50% tomorrow, I will not sell. Why? Because I am a net buyer, because I own a slice of the entire global economy, index funds, and unless the world ends, in which case money doesn't matter, human productivity will recover, because dividends are being reinvested at lower prices. If you own individual stocks, like just Tesla or just Apple, a 50% drop is scary because that one company could go bankrupt. But if you own the S&P 500 or a total world stock ETF, a bankruptcy of the entire index means civilization has collapsed. At that point, you should be worrying about canned food and ammo, not your 401k. As long as civilization functions, the index recovers. Homework: the fire drill. Here is your assignment for part 4. I want you to simulate a crash. Log into your investment account. Take your total balance, multiply it by 0.5, 50%. Write that number down on a piece of paper. Example, you have $50,000. Write down $25,000. Look at that number. Really look at it. Imagine logging in tomorrow and seeing that number. Does it make you physically ill? Does it make you want to sell everything to save what's left? If you panic, your asset allocation is too aggressive. You might need some bonds or cash to sleep at night. If you shrug, you are ready. You understand that the $25,000 loss is just a temporary mark-to-value loss, not a realized loss. Your goal is to get to a place where you can look at a 50% drop and say, "Great, stocks are on sale." In the final part of our masterclass, we are going to discuss the end game. You have saved, you have invested, you have weathered the crashes. Now, when do you sell? How do you rebalance? And most importantly, when is it okay to stop saving and actually enjoy your life? We're covering Part 5, the exit plan. I'll see you in the finale. Part 5, the exit plan. Rebalancing and enough. Imagine you are running a marathon. You train for months. You endure the pain. You run the 26.2 miles. You cross the finish line. And then you keep running. You run past the metals. You run past the water station. You run out of the city and into the desert. You keep running until you collapse and die. This sounds insane, but this is exactly how most people treat money. They spend their entire lives accumulating, saving, investing, stressing, just keep buying, but they never defined the finish line. They never asked, what is this money actually for? We have spent the last 4 parts of this masterclass teaching you how to build a fortune. We taught you to focus on income, to ignore the dips, and to lump sum your cash. If you follow those rules, you will get rich. That is the easy part. The hard part, the part the numbers can't solve for you, is knowing when to stop. Welcome to the finale of the Just Keep Buying Masterclass. Today, we are going to cover the mechanics of maintenance, rebalancing, the strategy of withdrawal, selling, and the philosophy of the crossover point. We are going to answer the ultimate question: how do you win the game of money so you can stop playing it? This is part 5, the exit plan. The maintenance: how and why to rebalance. First, let's handle the mechanics. You have been buying stocks for years. Your portfolio is growing. Do you just leave it alone forever? No, you need to rebalance. Rebalancing is the act of resetting your portfolio back to your original target. Let's say your target is 80% stocks, risky or growth, and 20% bonds, safe or stable. After a massive bull market, like the last few years, your stocks have grown so much that they now make up 90% of your portfolio. Your bonds are only 10%. You are now taking more risk than you intended. If the market crashes now, you get hit harder. So you sell some stocks, selling high, and buy some bonds, buying low, to get back to 80-20. Why rebalancing matters is not about maximizing returns. It's about controlling risk. It forces you to do the thing that feels unnatural, sell the winners and buy the losers. It's a disciplined way to buy low, sell high, without having to predict the future. When to do it? Don't obsess over it. Maggiulli suggests 2 simple methods. Calendar rebalancing. Check once a year, for example, your birthday. If you're off target, fix it. Threshold rebalancing. Only fix it if you are way off, for example, more than 5% off your target. The exit. When to sell. Eventually, the just keep buying phase ends. You retire, or you buy the dream house. You need the cash. How do you sell without ruining your portfolio? Maggiulli suggests a simple heuristic for spending down your wealth, widely known as the 4% rule. Historically, you can withdraw 4% of your portfolio in the first year of retirement and adjust that amount for inflation every subsequent year, and you have a 95+ chance of never running out of money for 30 years. Example, you have $1 million. Year 1, you withdraw $40,000. Year 2, inflation was 3%. You withdraw $41,200. The psychology of selling. This is harder than buying. You have spent 40 years wiring your brain to save. Seeing the account balance go down feels like dying. You have to rewire your identity. You are no longer the accumulator. You are now the consumer. If you don't make this switch, you become the richest person in the graveyard. The crossover point. How do you know when you have reached the finish line? Vicki Robin, author of Your Money or Your Life, calls this the crossover point. This is the exact moment when your monthly investment income exceeds your monthly expenses. Expenses, you spend $5,000 a month. Income, your portfolio pays you $5,001 a month via dividends or the 4% rule. At this moment, you are technically free. You never have to work again. You can choose to work, but you are no longer trading time for survival. The trap? Most people hit the crossover point and they ignore it. They increase their lifestyle. They buy a bigger house. They upgrade the car. Suddenly, their expenses are $8,000. They are no longer free. They have to keep running. This is called lifestyle creep. The only way to win is to define enough before you get there. Write it down. I need $2 million. Once I hit $2 million, I'm done. I will not move the goalpost. Die with zero? This brings us to a controversial idea by Bill Perkins, often discussed alongside Maggiulli's work. If you die with $5 million in the bank, did you win? No, you worked for free. You traded years of your life, years you could have spent with your kids, traveling or resting, for a number on a screen that you never used. Maggiulli argues that while just keep buying is the strategy for accumulation, you must eventually switch to a strategy of enjoyment. Money is a tool to transfer utility from your high-earning, low-time years to your low-earning, high-time years. If you don't use the tool, you are just a hoarder. The memory dividend. Spend money on experiences early. If you go to Europe at age 30, you get to remember that trip for 50 years. That memory pays a dividend of happiness every time you recall it. If you wait until 80 to go to Europe, you might be too tired to enjoy it, and you only get 5 years of memory dividends. Don't delay joy for a future that isn't guaranteed. Conclusion. The real goal. Let's wrap up this masterclass. Why did we do all this? Why did we learn about DCA and cash drag and income growth? Was it to have a Ferrari? Was it to impress the neighbors? No, it was to buy autonomy. The purpose of wealth is to wake up in the morning and say, I can do whatever I want today. Nick Maggiulli's data proves that you don't need to be a genius. You don't need to be lucky. You just need to be consistent. Focus on your income, human capital. Save what you can, but don't starve yourself. Buy a diverse portfolio, low-cost index funds. Ignore the news. Volatility is the fee. Just keep buying. If you do that, the math guarantees the result. The only variable left is you. Will you stay the course, or will you get scared? We hope this series has given you the armor you need to survive the journey. Final homework, the enough number. Your last assignment is simple but profound. Take a piece of paper, write down your enough number. Is it 1 million? 5 million? Calculate it based on your expenses. Expenses times 25 is a good rule of thumb. Put that number on your wall. Run towards it, and when you cross it, stop running. Thank you for listening to the Just Keep Buying Masterclass.